You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. The war in Iran has boosted prices for fertilizer and diesel, two components essential to agricultural production. The impact on consumer food prices will take months or even a year to materialize because of the time between when crops are planted and when they reach grocery store shelves. The magnitude and lag of this pass-through is unclear, a big reason the Fed will remain patient before officials feel confident assessing how the war has affected broader consumer prices. On today's episode, we talk with Alexis Maxwell, Senior Analyst for Fertilizer with Bloomberg Intelligence, about the war's impact on agricultural production costs, how farmers hedge against these input disruptions, and when the commodity shock will show up in consumer food prices. Stay tuned. Coming up soon, our interview with Alexis Maxwell, but first, a quick market update. The U.S. and Iran are still working to finalize a peace agreement despite promises from U.S. officials last week that talks were in their final stages. Both sides are interested in normalizing ship traffic in the Strait of Hormuz, but are struggling to find common ground regarding Iran's nuclear enrichment, sanctioned assets, and who will exercise control over Hormuz. Last week, Fed Governor Chris Waller said he would support removing the FOMC policy statement's easing bias, saying that the war's inflation risks mean a rate cut is no more likely than a rate hike as the next policy move. Waller has been one of the more dovish FOMC participants, dissenting as recently as January in favor of a rate cut, so his pivot is an important inflection point in Fed sentiment. While we still believe the bar is set high for the next move to be a hike, Waller's shift shows policy tightening is not nearly as implausible as it seemed only a few weeks ago. The April PCE deflator rose 0.4% headline and 0.2% core this week, both a tenth less than expected. Core inflation has accelerated slightly since the war began, but investors and policymakers believe the most worrisome pass-through from higher energy prices will happen in later months. The Treasury curve bull flattened on net over the last 2 weeks. The belly of the curve traded within relatively narrow ranges and reacted most to war developments and Governor Waller's public comments. Yields at the long end of the curve reached their peaks early last week in a momentum trade before rallying closer to prior support levels. 10-year yields are trading at 4.47% as of recording, after reaching 4.68% last week. Fed funds futures briefly priced in a full rate hike by the end of this year, but have since retraced to pricing in only 16 basis points of policy tightening through the December meeting. Kevin Warsh was officially sworn in as Fed chair last week and will preside over his first Fed meeting next month. He has not spoken publicly since his congressional testimony, so investors will be laser-focused on how he approaches his first meeting as chair. That's all for the market update this time. Now our interview with Alexis Maxwell. Our guest today is Alexis Maxwell, Senior Analyst for Fertilizer with Bloomberg Intelligence. Alexis, thanks for coming on the podcast.
Oh, thank you for having me.
Our topic today is the war in Iran's impact on agricultural production and food prices in the U.S. Now, we're just under 3 months into the war in Iran. Prices at the gas pump are up and airfares have risen, but the worry for bond investors and those at the Federal Reserve is that these higher costs are going to pass through to other consumer prices with more of an indeterminate lag. Alexis, to start things off, how should we think about the ways that the war in Iran and the closure of the Strait of Hormuz are having an impact on agricultural production?
Sure. It's a great question with a longer term horizon answer. So I'm going to walk you through first the supply side impacts and then how the material moves through the chain and what that means for the food consumer. So with the closure of the strait for the fertilizer market, the world lost access to exportable fertilizer, mainly nitrogen, phosphate, and sulfur. And farmers around the world use what we call NPKs, your nitrogen, phosphate, and potash materials, and they use a different flavor depending on what crop they're producing. But with the strait's closure, we lost about 40% of globally exported urea about 20% of the world's ammonia, which is a precursor to urea, and then about 20% of global phosphate, as well as 50% of sulfur, which is an input to phosphate. So a lot of different products were impacted, primarily on the nitrogen and phosphate side. Potash is escaping relatively unscathed. And so what this means for the supply chain for agriculture and for foodstuffs production is when the strait first closed, this was just about at the start of the spring planting season for the Northern Hemisphere. So in the United States in March, I would say, Will, we probably had about 50 to 60% of the fertilizer in the ground for crops that are going to be grown in 2026. That's a pretty decent amount already in the ground ready to go. And that's because of the US's split application season. We do a little bit in the fall that precedes spring planting, and then the spring planting season. Most of the fertilizer in the US was already here. But what we saw happen in the market with the initial closure of the strait was that urea prices jumped about 80% on the strait's closure. And we saw the relative price of urea, which is how farmers assess how much urea they want to apply on their individual crops. We saw that touch a record level in April. And so now we're 3 months into the closure of the strait. The supply chain has thinned, and we're looking ahead to the second half of the year because those are the crops that people are buying fertilizer for now. They have access to very costly fertilizer, and there's not a lot of it to go around. And so that means that we're going to see less fertilizer consumption on crops like probably the European Union's winter wheat. India plants rice, cotton, and sugarcane. They need fertilizer in the third and fourth quarter. Thailand and their rice production. And then Brazil is the world's third largest fertilizer consumer. They're a powerhouse in the agriculture market, and they do a lot of application in the third and fourth quarter. So really, Will, what we're starting to see now is the forward-looking view of crops that will come online in 2027 are going to be impacted by the strait's closure with more costly fertilizer.
A lot of interesting things there that I want to follow up on. And first, just to really underscore that, the idea that 2027 crops are going to be impacted by that, I think, is a great way to show how much of a delay there is in a lot of the kind of impact between higher commodity prices and the prices that we see at the grocery store. You mentioned how there are kind of different flavors of fertilizer that use different amounts of these components. So what does the universe of alternatives look like for farmers? Is there a readily available amount of fertilizers that are kind of immune to these recent price changes, or is it pretty inelastic in the short run?
For your nitrogen and phosphates, there aren't that many alternative products available. On the nitrogen side, you can go to ammonium sulfate, which is a less widely used form of nitrogen that comes primarily out of China. But China has excess fertilizer today in the market, but they have initiated an export ban on their nitrogen and phosphate materials. So the world can't even get to that excess supply because China is taking a China first policy standpoint to protect their farmers. I've had some people ask me about organic fertilizer as an option for your conventional nitrogen and phosphate supply, but really, Will, it just doesn't work to the same extent. This is really a question of math. And when you buy a ton of urea, for example, urea is the most commonly used form of nitrogen. It's really easy to apply. Farmers around the world use it and love it. 1 ton of urea fertilizer is 46% nitrogen. If you buy a form of organic nitrogen fertilizer, it's only about 2 to 3% nitrogen. It's almost a matter of a tenfold difference between the conventional and the organic, more so in conventional's favor. And so you just don't really get the benefits from organic fertilizer as an alternative. So to circle back to your question, there aren't really good options available on the market today in the absence of what we lost with the strait's closure.
I'm going to expose my background as a guy who grew up in the suburbs and works at a computer screen. How important is fertilizer to crop yield? If you just don't use fertilizer at all, does that mean
Mhm.
crop yields are going to go down 5% or like 70%?
That's a great question. First, I want to say that the importance of conventional fertilizer cannot be underestimated. I cannot think of an invention that is more important to more numbers of people globally than conventional fertilizer. We invented the Haber-Bosch process in about the 1910 decade, and that gave us conventional nitrogen. And what we saw was also global population going from 1 to 2 billion upwards of 8 billion today. Some people in the space will say that about half of the world's population exists because conventional fertilizer feeds the cropland that feeds the people. However, I don't want to underestimate also the importance of crop genetics and weather at the time of planting. And so that kind of brings me to one of my favorite anecdotal stories, and it's about Sri Lanka. In 2021, facing rising fertilizer prices, the government of Sri Lanka decided that they were going to ban the use of conventional fertilizer. Prior to this ban, the government had been procuring conventional fertilizer and giving it to their farmers. And so overnight, the country went from all conventional fertilizers to all organic. It was a bit of a disaster. The policy lasted 7 months. And that year, we saw rice yields in Sri Lanka fall 25% from trend. So, Will, I kind of use that as a baseline to start thinking around how crop yields might fluctuate given the loss of supply that we have with the Strait of Hormuz currently closed.
Obviously, no one knows when the war will end, how it'll evolve, when commodity prices are going to come back down. But, maybe this is all really temporary and everything's going to be resolved tomorrow. Are there farmers who see this increase in production costs and just decide to pause production altogether and wait for prices to come back down rather than go ahead and incur higher fertilizer costs? Of course, it kind of has the same impact on consumers because there is a lower supply, but you could see how it is a very different approach than incurring the higher production costs and then passing it on to the consumer.
Yeah, so some money is better than no money, if you're trying to make a planting decision. So, what I would anticipate is some farmers on the margins who cannot cash flow these fertilizer prices, they'll pull back on fertilizer consumption and they may plant this year. But to see like a large scale shift in the amount of area planted to crops like in the US because of these fertilizer prices, that's a multi-year story. And to your point, Will, too, it could end up that tomorrow the strait does reopen and then we see fertilizer prices fall in response. It does make for a really difficult operating environment if you're running a farm because farmers think on an annual basis. They apply fertilizer once or twice per year. They're not really in the market every single day trying to manage their cost of production expenses. They also have a lot on their plates as well.
The jumping off point for agriculture in the US or globally on February 27th, February 28th, what was it like? The focus of so much of last year's tariffs were on things like cars, semiconductor chips, manufactured goods, but did food fit into all of those trade policy changes? And was there a kind of healthy equilibrium that agriculture was in? Was there a surplus, a shortage? How do you look at that pre war jumping off point?
So if we were to just look at, let's say, for example, a US corn farmer's balance sheet, heading into 2026 was going to be the fourth year of negative returns for a US farmer. And so what we saw in the operating environment is the government stepping in with increasing amounts of federal aid to support the agriculture industry. We also had seen some relief on the tariff side for fertilizers with the removal of effectively just about all tariffs on fertilizers coming into the United States and the designation of potash and phosphate as critical minerals in the US over a longer term, like decade period, going to boost domestic supply for those crop nutrients, which will help the American farmer. But it is a poor operating environment if you're a farmer in the US today.
You mentioned how this season is very important for producers in the US, and oftentimes they're only going to use fertilizer as an input maybe a couple times a year. But beyond that, are producers able to smooth out the impact from these higher production costs through the futures market, or do they have inventories of fertilizer, for example?
Yeah, the US is the most sophisticated fertilizer market in the world, and there's a very strong seasonality to how a farmer will buy fertilizers in the US because we have those two distinct seasons. What we see some farmers in the US do is they will pre-buy their fertilizers. Usually that happens in the third quarter. And so last year we had some farmers buy in the third and fourth quarter, and so they got ahead of these sharply higher fertilizer prices. There is a fertilizer futures market. It's a bit more thinly traded, but in terms of hedging risk, what a lot of farmers in the US will do is they will pre-buy. For 2026, a lot of US farmers did escape, particularly in the Midwest, I would say, less so in the Southeast and maybe Western regions. They did escape the impacts of these sharply and relatively higher fertilizer prices.
So, putting that all of that together, it really sounds like the war's impact on consumer food prices. Have we seen any evidence of it at all? In the middle of May now, fertilizer was pre-bought and a lot of the stuff in the ground in the springtime was already there before fertilizer prices went up. Are the first really material signs of production costs being passed on to consumers going to happen in 6 months? I mean, what do you see as that timeline?
Yeah, it is a longer timeline, and inflation kind of boils slowly and then all at once. I would say the first order of impacts we would expect to see on the food market here in the US would be higher costs for go to market. So higher diesel, higher gasoline, moving your foodstuffs to the end consumer. That's where we're going to start to first feel the pinch. I think the inflation readout that we got most recently was at 3.8%, which the industry has taken as a rebirth, if you will, of the inflation story that we saw sort of 2022 into 2023. And so when farmers manage their cost of production, a lot of it, especially for what you might, see at the grocery store, like your tomatoes, that's going to be contracted on an annual basis. So the impact of these higher fertilizer prices is going to be something additive into second half of 26 into 27, a little bit longer horizon than the immediate impact of higher diesel and labor costs.
You mentioned how diesel prices have gone up, and of course, that is a part of the transportation from the farm to the grocery shelves. There's so much focus on fertilizer and its connection to agriculture, but how energy intensive is it? Is diesel already a big component in agricultural production, and the cost of that going up is also another big impact we're going to see?
The more that diesel goes up, the more the farmer's conscious about how many times they want to go across the field with their tractor to do field work. So that could include planting their seeds. It could imply maybe less runs of herbicides or fungicides, maybe a little bit less fertilizer, because every pass across the field is going to cost you money. So that's something the farmer's going to be thinking about when they run their springtime operations. But to go back to how energy intensive is the fertilizer industry, I will say first, nitrogen is the most energy intensive fertilizer product. Nitrogen is made from cracking natural gas. And so the price of natural gas is really correlated with the price of ammonia. It takes about 33 MMBTUs of natural gas to make 1 ton of ammonia. So if you have an idea of, where the natural gas market is trading, particularly in Europe, where prices are treading water around that sort of 14 to 16 MMBTU level, you can just run it through the chemical process and get an idea of where the price of ammonia should be. Now, phosphate, it's basically three components: ammonia, sulfur, and then phosphate rock. Phosphate rock is a mineral deposit, so either you have it or you don't. And then potash is a little bit of the same story. It's a mineral deposit. We find it mostly in Canada and Eastern Europe. So those are a little bit more mining heavy in terms of their cost of production versus nitrogen.
As sensitive as gasoline prices are to movements in crude oil prices, crude oil only represents about a half of what you pay at the pump. There's the refining costs, taxes, distribution. So many things other than oil go into that price for a gallon of gas that aren't changing day to day. How important is fertilizer or diesel to the overall cost of agricultural production? Just as one example at the extreme end, if a coffee shop's Wi Fi subscription doubled from $50 a month to $100 a month, I don't think they're going to jack up their prices for their cup of coffee. But if you are a gasoline station, that's the other end of it where it's you're going to pass on those costs really quickly. So where does agricultural production fit into that when it comes to fertilizer or diesel?
If we think about this first from like a farmer's cost of production, the farmer on their cash expense, about 30 to 40% of their cash expense is fertilizer. Diesel is closer to like 5 or 10%, but diesel is also one that you're paying more consistently all the time. If we look at like what it would cost to go to markets and where does the diesel and fertilizer fit in, the fertilizer is probably less than 2% of what you would pay for the food that you have at the grocery store. The diesel, the labor, all of that is more influential on what you buy at the grocery store than just the fertilizer alone.
Within the universe of foods, is fertilizer dependency pretty consistent, or are some foods much more reliant on it than others?
About 25% of the nitrogen consumption in the US goes to your fruits, vegetables crops. Your corn is a heavy nitrogen consumer, and soybeans take almost no nitrogen. And so, what we're starting to see develop here in the United States is as farmers are weighing the relative return of corn versus soybeans, this is a perennial debate in the Midwest. How many acres are farmers going to plant to each respective crop? Now, the USDA came out in March and said they think US farmers are going to plant 95 million acres to corn this year. Now, that's already down from last year's 98, and we think there's more room to the downside where we could see corn acres this year probably 93 and a half to 94. And that's because farmers are weighing more costly fertilizer expense on the corn side versus soybeans.
Do you think there's one market indicator that sums up all of these pressures we've talked about that is a pretty good leading indicator for where food inflation risk from the war is going in the next 6 to 12 months?
I'm personally tracking the price of major commodities, corn, soybeans, and wheat, and also the price of diesel, in addition to fertilizer prices. Not to sidestep your question, I realize I gave you more than one, but it is a complex, and it all does work together.
Yeah, no, totally reasonable. I think a lot of people are just measuring the anxieties from the war in crude oil prices, and of course, it's an imperfect proxy. But for food inflation, especially, these lags are so interesting, and so it's just notable to think of what might be happening today and how that's going to impact the future. I want to end with a question about where you think people are most underappreciating the war's impact on food prices. So everyone seems to oversimplify the analysis of the war's impacts on the economy as crude oil, liquid natural gas. What do you think most people are missing when they think about the impacts on food?
We talked a little bit earlier about farmers on the margins are going to be the ones who have to go without fertilizer. And it's probably those farmers who are least able to manage lower crop yields. And so I'm thinking in particular, the closer you get to the strait, the more likely it is that you're reliant on Middle Eastern supply for your fertilizer. And those are going to be the regions of the world that are going to have impacts to their food production. So I'm thinking about Africa in particular. I'm thinking about India, Bangladesh, Pakistan. And when we think about sort of third world countries, let's say in Africa, what's also happening politically in the background as well is that a lot of international aid programs have declined in terms of their funding over the past, let's say, year or two. And so it's a story that I'm going to be watching is how farmers and the population in Africa manage through this sort of dual crisis of less domestic food production and less options to turn to for aid.
As a part B, a follow-up to what I called my last question, do you think those farmers that are on the margins in the US or globally, there will be a pretty significant number that can't really absorb this higher production costs and essentially become insolvent?
Yes, that is what is going to happen. It's a matter of years to answer that question when the insolvency would happen. And I can just conclude by saying at this point, I'm hoping for agriculture's sake and food production's sake that we can see a resolution soon to the closure of the strait.
Alexis Maxwell, thanks for coming on the podcast.
Thank you so much for having me, Will.
That was Alexis Maxwell, Senior Analyst for Fertilizer with Bloomberg Intelligence. I think the idea that food inflation may not peak until spring 2027 is a helpful representation of how lagged the impacts can be on consumer prices from the closure of the Strait of Hormuz. Gasoline prices rose quickly after the war started, but so many other goods and services have long production times or inventory buffers that mean the pass-through occurs slowly and over a much longer period. Food services like dining out are included in the core PCE too, so this inflation risk from food prices is not limited to headline measures. Investors will primarily focus on US-Iran developments for the foreseeable future. There will be significant relief once the Strait of Hormuz reopens, but ship traffic is unlikely to normalize until firms have complete confidence in the safety of the passageway and sustainability of any peace agreement. The data calendar picks up next week with the May ISM's April JOLTS and May ADP employment in the first half of the week. All will help set the tone before the May jobs report on Friday shows how the labor market weathered elevated energy prices last month. The consensus currently expects the unemployment rate to be unchanged at 4.3% and payrolls to grow by 95,000. The following week, the CPI, PPI, and retail sales for May will all be released. Investors will of course be keeping an eye out for upside inflation surprises, but a slowdown in retail spending from higher gas prices could also lower economic growth expectations. A few Fed officials are scheduled to make appearances next week before the customary pre-meeting communications blackout begins at the end of Friday, June 5th. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.